everyone, and good afternoon. Today, I just figured we'll do episode 2 of whatever's on my mind. And today, the main thing that's on my mind is the stock market. I haven't been doing much trading at all. I actually haven't been trading for the past couple of days, just kind of hanging on to my short premium positions because if anyone has seen, if anyone's watching the VIX has blown up and is finally now falling back down. And this is where you find that the inverse correlation between the action, or the direction, I should rather say the direction of the stock market is moving in perfect correlation with the direction of the VIX. So stock market is down, VIX is down. Same with oil, as oil has been tanking and volatility has been following and been going down as well. And I think it's time that we kind of discuss how the practice of doing something is completely different from theoretical. I'm not sure if anyone has seen the video about how I said that my Tesla call, my short call spread for Tesla was actually gaining value, or I should say not gaining value, but losing value, even though the stock was moving against me. And the reason why it wasn't very much nominal. The reason why it was gaining value is because the volatility of the further out of the money option, which was the option that I owned, was actually, the volatility was expanding faster than the short option that I was short. So it's very interesting when you watch these things unfold in front of you in your own account, because you just there's no really other way to feel that kind of emotional pain you have when positions are working against you, and you can see how the positions are, working, and how you are controlling quite a bit of stock delta and volatility and time when you are holding these positions. And I've decided I have a lot of butterflies. So butterflies are trades that you kind of hold until the last minute. The reason I do butterflies is it provides me with a better outcome chance, I guess you could say. If I am a lot of my butterflies are broken winged spread butterflies. So what happens is I'll buy a put spread, for example, and then I'll sell another bigger put spread. And what that does is it provides a kind of net credit situation where I'm selling this butterfly and I can make money if the stock expires somewhere in between my long put spread and short put spread, that first one that I had bought, that put debit spread portion. And I also will make money as long as the stock ends above that. I might not make a lot, but it's a very low risk trade because I can sell these butterflies, one whole standard deviation outside the move of the stock. And that's pretty much what I have in Tesla. I have a put broken wing butterfly all the way down at like the 570 strike when the stock was trading at 850. So it's a $300 almost difference. The stock would have to drop over, or about $300 just for me to start losing any money. So it's kind of a trade that I put on for really slow theta decay, but it gives me a chance to kind of be in the market without having to be in a margin account. I have an IRA account, so I can't trade like I would have much rather traded something like a call ratio spread or a put ratio spread, but I can't. But those kind of positions kind of illustrate how close spreads work with each other. For example, if I were to sell a $5 wide call spread, the stock would have to move severely in the opposite direction for me to gain profit on that trade immediately. If it was a 45-day dated option, I'd have to wait a bit, and I need the movement. If I have a further out of the money, way far, maybe a whole standard deviation or two, and and then the stock moves, I'll have a better chance. And a lot of that has to do with volatility. And volatility is a really big component in the options pricing. And as you get closer to the options expiration date, sort of the gamma plays a big role. That's like the acceleration or the second level derivative of delta. And then you have VAMA, which is the second level derivative of vega, which is the volatility component to the option. So you have a lot of things moving when you're dealing with options, and unless you own the option and you either, so number one, if you own the option for the delta, you have to be in and out quick, because if you're in it for the delta, then once the stock price moves against you, you have to just exit. It's just how it is, because you will lose delta really fast when the stock price moves against you if you're buying options for delta. Usually when you buy or sell options, like the way that the tasty work mechanics do, you're not actually trading an option for pure delta. You're trading it because there's a little bit more mechanics in the option trade that will allow you to be not completely correct and still make some money. So you're giving up that instant pain and you're giving up instant gain. So you're saying, I'm going to be in the trade for a couple weeks, and I'm going to give up getting like a huge gain in a couple minutes for a gain in 3 or 4 days, 2 or 3 weeks. That is going to provide me with a far better odds than if I just held it for a couple minutes or half an hour or something. So that's kind of what's been on my mind, the effect of trading and how you really have to be trading to speak on any of these things. Like, you can't just say, oh yeah, options are risky because that's what the options book from the CBOE or Siegel says. You have to kind of be like, okay, options are risky because I blew up like 4 or 5 accounts with it. I didn't know what I was doing, obviously, and it's just really risky. You shouldn't let people do it like that. But that's really, you have to have personal experience before you can make any kind of judgment on the thing. That's what I think for trading, especially for trading, because you don't know until you have some kind of a personal experience where you're feeling this pain. That's kind of how I've been able to deal with most of this stuff. But I will see you guys in the next video.